Hello viewers and welcome to our channel. In this comprehensive guide, we'll delve into the intricacies of cryptocurrency taxation, helping you understand your obligations and optimize your tax strategy. So without further ado, let's dive into the video and subscribe to the channel. Cryptocurrency is no longer the new investment asset on the block, and that means income derived from crypto is getting plenty of attention from the IRS in 2023. Unfortunately, the crypto tax rules remain a bit complicated. The IRS clearly states that crypto may be subject to either income taxes or capital gains taxes, depending on how you use it. How is cryptocurrency taxed? First off, you don't owe taxes on crypto if you're merely hodling, as aficionados would say. But when you gain any income from crypto, either from staking, lending, or selling, you may owe taxes on the proceeds. The IRS treats all cryptocurrencies as capital assets, and that means you owe capital gains taxes when they're sold at a gain. This is exactly what happens when you sell more traditional securities, like stocks or funds, for a profit. Let's say you bought $1,000 in Ethereum and then sold the coins later for $1,600. You'll need to report that $600 capital gain on your taxes. The taxes you owe depend on the length of time you held your coins. If you held your ETH for 1 year or less, the $600 profit would be taxed as a short-term capital gain. Short-term capital gains are taxed the same as regular income, and that means your adjusted gross income determines the tax rate you pay. Federal income tax brackets top out at a rate of 37%. To find yourself in the top bracket for the taxes being paid in 2023 on 2022 income, you would have earned more than $539,900 last year as a single filer. 2022 federal income tax brackets, taxes due in 2023. The 2022 federal income tax brackets, applicable for taxes due in 2023, vary based on filing status. For single filers, the tax rate is 10% for taxable income up to $10,275, 12% for income between $10,275 and $41,775, 22% for income between $41,775 and $89,075, 24% for income between $89,075 and $170,050, 32% for income between $170,050 and $215,950, 35% for income between $215,950 and $539,900, and 37% for income over $539,900. For married individuals filing jointly, the thresholds are doubled, and for those filing separately or as heads of households, intermediate thresholds apply. These brackets determine the tax rate applied to your income within each range. If you held your ETH for 1 year or more before you sold them for a profit, you would qualify for the long-term capital gains rate. For many filers, this rate is lower than regular income taxes, although it depends on your AGI. 2022 long-term capital gains tax rates, taxes due in 2023. The tax brackets for the 0%, 15%, and 20% rates, categorized by tax filing status, are as follows. For single filers, the 0% rate applies to taxable income up to $41,675. The 15% rate applies to income between $41,676 and $459,750, and the 20% rate applies to income over $459,750. Married individuals filing jointly have thresholds doubled, with the 0% rate applicable to income up to $83,350. The 15% rate for income between $83,351 and $517,200, and the 20% rate for income over $517,200. Married individuals filing separately and heads of households follow similar patterns, with intermediate thresholds. These brackets determine the tax rate applied to various income levels within each range. Taxes on crypto payments, staking, and mining. If you earn cryptocurrency from mining, receive it as a promotion, or get it as payment for goods or services, it counts as regular taxable income. You owe tax on the entire value of the crypto on the day you receive it at your marginal income tax rate. Any cryptocurrency earned through yield-earning products like staking is also considered to be regular taxable income. If you hold cryptocurrency from any of these activities and either spend or sell it later for more than its value when you first received it, you owe short or long-term capital gains taxes on the profits based on how long you've held it. Money lost on crypto may count as a capital loss. When you sell an investment asset for a loss, you can deduct some of your loss from your taxes. If you sold crypto for less than you paid for it, you can also claim a capital loss and use it to offset other income taxes. How to file your crypto taxes in 2023. Cryptocurrency has transformed the financial landscape, offering unprecedented opportunities for investors and enthusiasts. However, the rise of digital assets has also introduced new complexities into the realm of taxation. Understanding how to navigate cryptocurrency tax reporting is crucial to ensure compliance with tax regulations, avoid penalties, and enjoy the benefits of this evolving financial ecosystem. The tax landscape for cryptocurrency. The Internal Revenue Service, IRS, in the United States now explicitly addresses virtual currency transactions on the standard Form 1040 tax return. This form includes a direct question. At any time during tax year, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? This clear inclusion underscores the IRS's growing focus on cryptocurrency tax enforcement. While it's important to note that merely purchasing cryptocurrency is not inherently a taxable event, the sale of cryptocurrency triggers tax obligations. Cryptocurrency transactions, whether trading one cryptocurrency for another or converting cryptocurrency into fiat currency, can have tax implications. To navigate this complex landscape, meticulous record-keeping is essential. Record-keeping. Accurate record-keeping is the foundation of effective cryptocurrency tax reporting. You must maintain detailed records of all your cryptocurrency transactions, including document how much you paid for each cryptocurrency, the date of purchase, and the source of the cryptocurrency, for example, an exchange or peer-to-peer transaction. These details establish the cost basis of your cryptocurrency. Note how long you held each cryptocurrency. In many jurisdictions, including the United States, the tax rate may vary based on whether you held the asset for a short term, less than 1 year, or long term, over 1 year duration. Record the amount for which you sold each cryptocurrency, the date of the sale, and the recipient, if applicable. This information is crucial for calculating capital gains or losses. Maintain receipts for every transaction, whether it's a purchase, sale, or exchange. These receipts serve as evidence of the transaction and can be invaluable during an audit. For each transaction, determine the fair market value of the cryptocurrency at the time of the transaction. Accurate valuation is essential for calculating gains or losses. It's worth noting that some cryptocurrency exchanges may provide a Form 1099-B to report your transactions to both you and the IRS. However, these forms may not include the cost basis or the original purchase amount for cryptocurrencies transferred between offline wallets and your exchange account. As such, relying solely on these forms may lead to inaccurate tax reporting. To streamline the process of tracking cryptocurrency transactions and ensuring accurate tax reporting, many individuals turn to specialized tools and software. Platforms like Coinly and CoinTracker can connect to your exchanges and wallets, automatically recording transactions and generating the necessary forms for tax compliance. Commonly used tax forms for cryptocurrency reporting. When dealing with cryptocurrency tax reporting, it's essential to fill out the appropriate tax forms based on your crypto activities. Here are some of the key forms you may need to complete. When it comes to cryptocurrency tax reporting, understanding the relevant tax forms is crucial. Form 1040 is the primary form for reporting annual income taxes and includes a section for detailing your cryptocurrency gains or losses. If you earned cryptocurrency through mining, Form 1099 and EC may apply. Form 8949 is used to log each crypto purchase or sale as an investment, helping calculate overall gains or losses. Schedule C determines self-employment tax if you received coins from mining as a business. Schedule D summarizes capital gains and losses, while Schedule Southeast calculates self-employment taxes for crypto income through self-employment. These forms are essential for accurate cryptocurrency tax compliance. Tax efficiency strategies. Navigating cryptocurrency taxes can be complex, but there are strategies to minimize your tax liability legally and efficiently. Optimizing your cryptocurrency tax strategy can lead to substantial savings. Firstly, consider holding your cryptocurrency investment for over a year to benefit from lower long-term capital gains tax rates. Secondly, offset gains with losses from other investments through tax loss harvesting, with a maximum deduction of $3,000 per year. Thirdly, strategically time your crypto sales to take advantage of potential lower tax rates. If you're a crypto miner, remember to claim deductions for expenses such as computers and electricity. Investing through retirement accounts like IRS can also help defer or avoid gains taxes, but follow IRS rules. Lastly, reduce your tax liability by donating a portion of your crypto profits to charity, gaining deductions based on fair market value. File your taxes. If you keep records in software like Coinly or CoinTracker, you can connect them with your online tax software of choice. Then use the online tax software to file your overall state and federal tax returns. For those looking for one-stop services, Token Tax provides a full suite of accounting services to track and prepare both your crypto and regular taxes. Consider hiring a professional. Preparing for cryptocurrency taxes can be complicated, especially since the laws surrounding them are constantly evolving. If you've made a substantial income from cryptocurrency, it may be worth hiring a certified public accountant, CPA, who specializes in this type of tax work, so you don't have the IRS chasing you down later. How to minimize crypto taxes. Managing your crypto investments with a tax-efficient strategy can make a significant difference in your overall tax liability. Firstly, consider holding your crypto long-term. If you keep your investment for at least a year before selling, you can benefit from the preferential long-term capital gains rate. Additionally, you can offset gains with losses from other investments through tax loss harvesting, allowing you to write off up to $3,000 per year. Timing your crypto sales strategically can also be advantageous, as waiting for a lower tax rate may be beneficial. If you're a crypto miner, remember to claim mining expenses, including equipment and utility costs, as deductions. Another option is investing in crypto through retirement plans like IRS, deferring or potentially avoiding gains. Lastly, charitable giving with crypto can reduce your tax burden, offering deductions based on the fair market value of your donated assets at the time of contribution. These tactics can help optimize your crypto investments while staying tax compliant. What happens if you don't report cryptocurrency on taxes? Failing to report cryptocurrency transactions on your taxes can have significant consequences. When you omit a taxable crypto event from your tax filings, you expose yourself to various potential repercussions. These can include the accrual of interest on any unpaid taxes related to your crypto income, penalties for underreporting or failing to pay taxes, and in extreme cases, even criminal charges if the IRS conducts an audit and uncovers intentional tax evasion. It's important to note that the IRS has become increasingly vigilant in tracking cryptocurrency transactions, and they have sophisticated tools at their disposal for identifying non-compliance. In less severe instances, you may receive a notice or letter from the IRS, prompting you to rectify your tax reporting and payments for your cryptocurrency activities. Therefore, it's crucial to accurately report all cryptocurrency-related income and transactions to ensure compliance with tax regulations and avoid potentially serious consequences. Conclusion: cryptocurrency taxation is a complex and evolving field, but staying informed and compliant is crucial. By understanding the tax regulations in your jurisdiction, maintaining accurate records, and seeking professional guidance when needed, you can navigate the world of cryptocurrency taxation with confidence. So this was our today's video. I hope you all like it. Don't forget to hit the like button and subscribe the channel. We will be back soon with a new video. Till then, keep supporting and take care.